Imagine you live in Uganda and you plan a trip to the United States of America. Before boarding your flight, you need to exchange your Ugandan shilling for the US dollar because the United States uses a different currency. That simplest act of exchanging one country's currency is what we call foreign exchange. But what if the currency changes every day? What if someone could buy one currency when it's cheap and sell it later when it has become more valuable? That is the basics of Forex trading. In today's lesson, we shall be talking about what Forex is, why does the Forex market exist, why is it the biggest financial market in the world, and what does the decentralization of the Forex market mean, who are the participants in the Forex market and their role, who is a retail trader, and why do people do Forex trading. Forex is a short form of foreign exchange. Forex trading is the buying of one country's currency while simultaneously selling another country's currency. Among the currency pairs that are traded currently in the Forex market include the Euro/USD, the JBP/the USD, the USD/the JPY, the AUD/the USD. So when you buy a currency pair, you are buying one currency while selling another currency at the same time. As the main goal at the end of it all is to profit from the changes within the exchange rates. Why does the Forex market exist? The Forex market exists because in the globe as currently right now, we have different countries, and of which each and different country are using different currencies. For instance, the United States of America uses the US dollar, the United Kingdom uses the British pound, the Japan uses the Japanese yen, the European Union uses the euro. Because countries trade goods and services with each other, there must be a way of exchanging these currencies. For example, a company in Uganda importing machinery from the German may need euro to pay the suppliers. A tourist traveling from Kenya to the United States needs the US dollar. An investor purchasing sales in a foreign country may need the country's currency. All of these activities create demand for the foreign exchange. Why is it the biggest market in the world? The Forex market is the largest financial market in the world. According to the Bank for International Settlements, more than $7.5 trillion traded every day. To put this into perspective, Forex trading is significantly larger than the global stock market in terms of daily trading activities. This anonymous trading volume creates higher liquidity. Because of this, traders can usually enter and exit positions quickly. What does the decentralization of the Forex market mean? Unlike stock markets that have central exchange, the Forex market does not operate from one physical location. There is no Forex building. There is no single exchange where all the Forex transactions take place. Instead, the market operates on a global electronic network. Banks, governments, hedge funds, brokers, traders using computers and trading platforms and the internet. This is the type of market known as over-the-counter market, commonly called the OTC market. Transactions occur directly between participants through a network rather than through a central exchange. Who are the participants in the Forex market? Many participants operate in the Forex market, and these include the government, the central banks, the commercial banks, multinational corporations, the hedge funds, and the investment firms. Retail traders. The governments influence currencies through economic policies and monetary decisions. The central banks as participants control interest rates and supply money. For example, we have the Federal Reserve in the United States, the European Central Bank, the Bank of England, and the Bank of Japan. Their decisions create major movements in the currency prices. We come to the commercial banks. The commercial banks exchange currencies for clients and conduct large-scale trading activity. Multinational corporations. These are large companies that exchange currencies when conducting international businesses. The hedge funds and investment firms. These are institutions that speculate on a currency movement and manage billions of dollars. The retail traders. These are individuals who trade like you and me. They participate through online Forex brokers. A retail trader is an individual who trades currencies using their own money rather than on behalf of a company or an institution. Retail traders access the market through online brokers and trading platforms. Interestingly, retail trading is currently new. Most of the Forex history, participation was limited to banks, governments, and large institutions. It is only within the last couple of decades that the technology has made Forex accessible to everyday person. Today, traders can open accounts with relatively small deposits and access the same market as the major institutions. So among the retail traders, we have categories of retail traders. We have the swing traders, we have the intraday traders, we have the scalpers. Swing traders. Swing traders, these hold positions for several days, weeks, or even months. They focus on large market movements. Whereas the intraday traders, these open and close trades within the same day. No position are held overnight. Scalpers. These hold trades for a very short period of time, often a few minutes. Their goal is to capture small price movements many times throughout the day. Why do people trade? People trade for several reasons. First, the Forex market is high liquidity. It is estimated that on a daily basis, the market has a liquidity of 7.5 trillion US dollars. Second, it operates 24 hours a day during the trading week. Third, traders can potentially profit both in rising and falling markets. Fourth, modern technology has allowed traders to participate from almost everywhere as long as there is internet. However, Forex trading involves risks. Success requires education, discipline, patience, and proper risk management. In the next session, we will learn how currency pairs work, how Forex market prices are quoted, and how traders make money from exchanging the exchange rates. See you in the next session.